Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, so before I jump onto the charts, because that's where most of my presentation really is focused on being able to look at what's going on out there, what are the tools that I use to try to forecast the dollar, which is really, that's ultimately the takeaway from my presentation. I wasn't too concerned about whether the dollar had collapsed by the time my presentation came up or was still growing in value, which such is the case right now. What I'm more interested in is sharing with you, what am I looking for as I forecast the dollar, and therefore, and how would I translate that into opportunities with some FX options? So I think this is a really exciting time, particularly actually with options, to take advantage of these big moves in the market. Let me answer one question before I go on. The question is, are Forex options, do they entail risk of losing more than your initial investment? If you are long options, so if you're long currency options, such as the ones listed on the with the ISE, if you are long those options, what you have at risk is the amount you paid for those options. So if it costs you $300 to buy a single contract of whatever it is you wanted to buy, your risk is $300. So because ultimately the bottom end of this is that option becomes worthless. Now, if you are short options, then things change a little bit, and we start looking, the liability looks a lot more like it does in the spot market or in the futures market if you're trading futures. So it's a real difference between being long the option or being short the option. Long the option, your risk is limited, but of course you have the disadvantages of time value and things like that. Being short the option, you have the unlimited risk on the other side. Okay, so I'm going to share my desktop here, and your screens will probably flicker a little bit. And then we go a couple of places, and I'm going to bring up my chat box here so I can see if somebody's chatting at me. So I brought up a couple of things. First of all, obviously, the ICE's website here, www.ise.com, a lot of great information about FX options, very focused on education, which I love. I'm really keen on being able to really give people tangible benefit for their time and attention. So if you're interested in learning more about spot FX, and how traders trade in the spot market itself, so trading currencies themselves, which a lot of us will do that and be hedging our risk or be enhancing our risk and profitability through options as well. So we'll combine the two markets. You can go to pfxglobal.com. We also have another site. We're actually merging the two sites. It's called learningmarkets.com, where we republish all of our Forex content as well as content on stocks and options. Okay, let's jump into the charts here. Now, by the way, I'd love it. I have my chat box open, not the Q&A box, so I can't see the Q&A box, but I do see the chat box. So if you have any problems, or if I'm going on and you don't see you're not seeing what I'm talking about, please give me a heads up, and I'll make sure that I pause and fix whatever problem it is. Okay, so one of the first things when I started the presentation, I listed that there were three big factors that I felt like were pushing the value of the dollar. And by just creating the inverse of those three factors, we can kind of decide, well, what are the benchmarks that we're looking for to identify the top of the dollar market? So we're going to start actually by looking at uncertainty. And in order to do that, I have several charts open right now, as you can see. I'm going to be zooming in on each of these in turn as I try to illustrate what are the things that I look for, and why do I think that these things are particularly useful right now for traders. One of the things that there is some debate about depending on what your trading philosophy is and what your style is how do you really define the dollar's strength, right? The question is always, well, the dollar is getting stronger compared to what? Compared to vintage bottles of wine, compared to gold, compared to the Australian dollar, compared to... So let me just define how I look at the dollar in general. And what you're seeing right now, this is the U.S. dollar index. It's actually a futures contract. Now, for those of you who don't have access to this kind of information, so maybe you don't have the dollar dollar index, which you'll see actually commentators, other traders, journalists, etc. They'll quote this. They'll talk about this as they talk about the U.S. dollar strength. However, that particular index is basically the dollar versus a whole batch of other currencies. Now, the largest component of that basket is actually the euro. So what I've brought up here is EUI. That's the stock symbol, or rather that's the index symbol for the options available on the ICE again for the dollar euro. And you'll notice that the two charts look very similar. Because you have the gap during off-market hours, you do get a little bit of gaps, which in my opinion as a technician is not a bad thing. I like to see gaps. They kind of help me identify some likely resistance, support and resistance levels. Okay, so I mentioned that uncertainty is one of the big issues that we're watching out for. And there's actually a great proxy to look for when you're trying to measure, well, what is investor uncertainty like? And although it's oftentimes called the equity sphere index, I think that it's just as powerful as a tool for, as just a proxy for fear in general. Because if investors are getting fearful about equities, well, equities are a high-risk asset. So if they're getting fearful about equities, they're probably, in general, fearful of most high-risk assets. And there are ways we can use that information. So let me give you, for instance, and you'll notice that the VIX, the way that the VIX works is that essentially it measures investor fear through, by an analysis of the implied volatility levels of the SPX index options. And periodically it will get to these real extremes, which I'm drawing little boxes around. Now it doesn't like the market, if we could kind of attribute human characteristics to it, it doesn't like being at these extreme levels, and it tends to reverse pretty quick. This gives us a couple of signals that we can use in our trading. So for example, I just drew some boxes around basically this resistance level that for a long time the market would get up above about 29 or so for several years. If it got up above 29, it wasn't going to stay there for very long and it would immediately plummet. However, there's two takeaways here. One is that we think that there is a very high probability that the market will turn around when it gets to extremes like this. So that's one issue. If fear does reach an extreme, and then in fact it does reverse and begin trending back down to the downside, that's good for equities. That's good for high-risk assets. Conversely, getting up to this level in the first place is also good for the dollar as it gets up to that level. And the reason why is because this fear index is essentially a measure of uncertainty. And uncertainty drives traders to quality assets like bonds, et cetera, that drive demand for the U.S. dollar that's required to purchase them. Now, by the way, for those of you who are thinking, yeah, but what about recently on the VIX? So for those of you who've been watching the VIX lately, you know that something else has been going on. Well, it's just as useful, and I'm going to get to that here in just a second. And by getting there, we're going to drive a point home about how would we use this to design a trade today. What would I be looking for today, and what would I be looking for to try to identify some weakness in the current trend? So I drew some boxes around these periods in the market where things got a little hairy, and we can go back to our chart of the euro dollar, or the dollar euro rather, and we can see every time this thing's going up. By the way, that's a dollar appreciating, and what you'll find is that those periods of real extreme uncertainty on the VIX essentially preceded a run-up on the value of the dollar. So you can see all the way going back here to November of last year. We see another one in January of this year where the market again paused, was not able to break support. A big one back here in March where the market ultimately formed its absolute bottoms, at least for the near term. And then once again, right here in September. So we get this little drawdown against the dollar. So this is not good for the dollar as it's going down. It's indicative of relative weakness against the euro and against most other currencies or most of the other majors. Bounces up and takes off again. Well, how might we have used some of our analysis of uncertainty analysis, if you will, to try to warn us that this was an opportunity to be upside?
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.